Equinox currently trades at about $5,700 per ounce of production, 2025, 2026. And the peer group average, I believe, is around $12,000 per ounce of production. The top quartile is trading around $15,000 per ounce of production. If you think long term, gold's probably going higher, it's flat to going higher in the long term, this is probably something you want to start looking at. I think it presents a very compelling opportunity at this point.
Hello again, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. I am really excited today because we have a great guest with us. He's going to speak on behalf of the new company he is part of, and that new company is Equinox Gold. And with us today is Ryan King. He is the Senior Vice President of Capital Markets and Strategy for Equinox Gold. And Ryan, first things first, let's get right to it. Calibre merging with Equinox or being acquired, that is now finished. But the Calibre shareholders, they were looking at this and they just expressed a lot of skepticism. They're worried about the higher costs. Everything has been going so well at Calibre. There wasn't a huge premium. So then why team up with Equinox? Why did Calibre management, which you were a part of, why did you guys decide, okay, this is better, this is best for the company in the long run?
Well, first of all, Jordan, nice to see you again. Glad to be back on the Daily Gold, an exciting YouTube channel. So appreciate that, and appreciate you taking an interest in Equinox. It is a very specific but very valid question. You're right. Calibre was on a great trajectory. We were on a solid path. And we saw an opportunity for share price performance in front of us, no doubt. By doing this merger, and again, I think it's really important for the audience to know that this is a true merger. We saw great opportunity to tier up in terms of total management quality, total asset quality, and there is a path now to becoming a top valued global gold producer with this merger, on the back of this merger with a strategic combination with Calibre. Because of those things I just mentioned, we're now on the cusp of ramping and delivering the Greenstone gold mine in Ontario. We're less than a quarter away from seeing first gold come out of Valentine. So birthing two substantial long life assets in Canada. And that's a critical element, because if you look at the key metrics for the top rated or top valued gold producers, the Agnicos and the Alamoses of the world, you could see that a substantial portion of their net asset value, mine life, and assets are located in Canada. So that's part of the reason why this merger makes a lot of sense. And it doesn't happen overnight. This will take some time to, as you just said, bring down some of those costs, deliver some of these new mines. And upon doing that, I believe we'll start to get re-rated, and we will be re-rated through this process, in my view. I mean, as we were just talking about before recording, you've seen quite a few insiders starting to buy more shares. Ross Beattie's recently bought more shares. Calibre's president or ex-chairman Blaine Johnson has bought more shares. Myself, Darren Hall. So there's a really compelling opportunity in front of us. And part of that tiering up in terms of management is Darren, with the significant operating experience that he has and what he did with Calibre as CEO. He's going to be bringing that operational excellence into the fold with this overall portfolio. So I'm very, very excited about the future.
Okay, great. Well, let's delve into those two big mines specifically. Let's start with Greenstone, because you talk about operational excellence, and that's what Darren and his team and you guys have been known for. So Greenstone, the last quarterly report, that noted that has not been ramping up as fast as expected. Equinox had to lower its guidance across the board. The stock has been weak because of that. So at what point do you think, I mean, first of all, give us an update of where Darren and you guys are with respect to Greenstone. And at what point do you think you can get this thing operating, or at least ramping up towards the guidance that everybody wants to see?
Sure. So again, I mean, most of your audience will know this, but Greenstone is a cornerstone asset within the portfolio. It's a new mine. Equinox owns 100% of this asset. First gold was last year. Commercial production was declared last year in 2024. Darren has spent some time at the asset with the folks there now. He's brought in some additional human capital to assist with that ramp up. Very specific skill sets in terms of folks that can have a fresh perspective or a fresh set of eyes into the asset to see where there are opportunities. And there's a number of opportunities, whether that be, minimizing some dilution when mining, when drilling, blasting, and mining, whether that be optimizing the overall total movement in the mine. And they're a little bit behind there, so we're working on ramping that up. Double side loading, some effective not new, but tools to help bring that mine to where the tonnage on a daily basis needs to be. So already having a pretty positive impact there on that development. I mean, in June, when we put out the revised guidance for the year, he talked about the mine now being about 175,000 tons a day. That's a 25% increase from where it was in Q1. So little things like this, Jordan, to help unlock that full potential. It's going to take some time. There's some work to be done still, working through some learnings on grade and different aspects there. But I'm very positive that through that team that we'll be able to unlock that. And I think you're going to start to see the benefits of it, probably starting in Q3 of this year. I would anticipate that probably by Q4, you're starting to get to that run rate, nameplate run rate from a 27,000 ton a day going through the plant. And the same kind of run rate needed at a nameplate to get on the mining side. So through the end of the year, we should be in a pretty good position. And just to touch on the costs for a second, I think Greenstone's guidance this year from an all-in sustaining cost is $1,700 to $1,800, and I think that was quite a shock for a lot of people and a disappointment. There's no doubt a disappointment. So that was a real reset for the company going forward, to reset those expectations. And then Darren and the operating team to come in and start delivering on some expectations going forward. If we look at Equinox and I would say as an Equinox employee now, we look at the history, we haven't been able to meet expectations over the last couple of years. Now with this strategic merger with Calibre, I think there's opportunities that we can do that now. And that's what this reset was just recently. So yeah, Q3, we should start seeing some operational benefits coming with the new leadership team there. I also believe if you step back, part of the reason why the all-in sustaining cost jumped up as much as it did is strictly because of the lower ounce production, right? So our denominator is smaller now versus what it was originally guided on. But when we look at the spend, for example, to operate that whole site, the spend isn't changing too much. You might see a little bit of increase, but really because the cost jumped up as much as it did because the ounce output went from 300 to 350 down to 220 to 260. So I believe once we get it up to nameplate and getting it up to where it's expected to be, you will start to see that all-in sustaining cost per ounce drop pretty substantially. So lots of developments underway right now, and Q2 very likely to be similar to Q1. I think we said in that press release 45 to 50,000 ounces, 135 to 145 on a consolidated basis. So we're probably right in that wheelhouse. And so I would want people to expect that type of an output. And therefore, the cost profile is probably going to be similar to Q1. And then things start to really turn in Q3 and Q4.
Okay, fantastic. You answered multiple follow-ups that I had for Greenstone. What are the challenges in getting this thing operating where it should be and ramping it up? Is it a function of time? I mean, you can't just get in there and change everything on the first day or the first week. I mean, if any, what challenges do you see that might impede you on this track to really getting Greenstone back to where it's expected to be?
Well, I think we're already making the steps needed to get there. For example, Calibre's chief operating officer, his name is David Schumer. David has actually relocated to Greenstone. So bringing in that human capital power, if you will, or perspective into that operation quickly will help change the effectiveness in the operation. I know that Darren and David have also brought in some expert loaders, so load and haul and load perspective. So there's been some specialty people coming in to assist with different ways to be a bit more effective and then maybe a bit more efficient. We have seen some tension on grade. So you know the Greenstone mine did have underground past production. So dealing with different voids within the open pits, you know, we are seeing some of that, you know, drill blast and then material falling into some of those voids. So you're getting a bit more grade loss there. So it's just figuring out all the different aspects of how to rectify that and working through that. So human capital is a big piece of this. But fortunately, Darren and Dave have a tremendous Rolodex. Good people that they can call on to support in these types of situations. So I think that's a big aspect of it. And yes, it will take time. And then it will take time of looking through the deposit models and reviewing all the different aspects within that as well. So pretty optimistic here at this point in time. After this reset, quite optimistic that we'll be able to meet those expectations and then grow beyond what is currently expected for the asset. So let's see how things go over the next little while. It'll be telling, you know, obviously it's nice to be in this type of seasonality. You're not working through the winter months, even though Equinox did go through a winter and it was challenging, but there's learnings that have come out of that. So I think those are probably the critical elements to get it to where it needs to be. And then we'll be able to provide the market some better clarity on Greenstone and Valentine on the Q2 conference call, which doesn't happen until August. The middle of August is when the Q2 conference call will come out, which is halfway through Q3. So obviously we'll be able to provide some additional granularity and color about how things are going at that moment in time and for the future.
Okay, great. So that's Greenstone. Let's talk about Valentine. So I believe your last guidance was a little bit delayed.
Yeah.
So what's the status of Valentine? When is that going to be turned on and spitting out gold? And at what point do you think that can reach the capacity that is expected?
Yeah, good question. So again, for your audience, I think most people would know this, but we're ramping up a major Canadian asset in Ontario. And then at the same time, Equinox is birthing another new open pit mine in Newfoundland and Labrador. So it's an exciting time because it's a major inflection point for the company. You're bringing on these two big cornerstone assets that will deliver between 500 and 600,000 ounces a year from these assets in Canada. We talked a little bit about the tiering up of jurisdictions. So things are going very well. We're confident that this mine will start it's going through wet commissioning in July. So water going through the plant. There's been commissioning of the primary crusher and a number of different elements of the operation. The operational leadership team is in place. You've got majority of your staffing done. So we've got a great quality core of people to deliver on the operations. That's really critical in any operation. But I think we're probably now 94, 96% complete in its total operation from the mine to the mill to tailings, etc. So feeling confident about where we're at. I would expect that ore is starting to go through the mill probably in the second half of August, putting us in a production to see first gold likely coming out of the plant. And this is a conventional, very simple process, crush, grind, CIL process in terms of, many types of these mills around the world. So there's no complexities to the plant. And we would anticipate first gold sometime in the second half of September, and then a gradual ramp up. So fortunately, we've got a team, a leadership team that's actually been in place through the last 12 months of construction. So they've brought some gravitas to the commissioning process, if you will, that I believe will help us be effective during the ramp up of Valentine. I would anticipate that probably sometime during Q1 or through Q1 of 2026, Valentine should be getting close to nameplate, barring it going according to plan, that there's no any sort of hurdles or challenges. We know that there likely will be some challenges along the way, but I believe the team has done a good job of looking at all the, the SWOT analysis, if you will, to see what could go wrong and putting preventative measures in place such that we can overcome that. One of the areas, one of the things that we've been doing over the last while is ore control drilling to really understand the deposit. We put out some news. Calibre put out a number of results talking about the 9 meter by 9 meter ore control drilling in the Leprechaun pit, in the Marathon pit. We're doing that now in the Berry pit. So feeling confident because so far we are seeing positive reconciliation on the ore tons and positive reconciliation on grade. So I believe that we're in a great position to deliver this new mine, and 2026 will be a significant year of transformation.
Okay, great. And at what point do you think the cash flow from Greenstone and Valentine can put a major dent in the debt that Equinox has? Because you guys do have a significant amount of cash, but now you also have, I think, 1.4 billion in debt. So that's a very big number that can turn a lot of investors away.
No, absolutely. And the mining business is a capital intensive business, especially as you go through building in tier one jurisdictions, these high quality but very large plants and operations. These are huge, massive operations, billions of dollars. So the company over the last few years, several years, has been in a capital investment season. So we've been investing in Greenstone, investing in Valentine, investing in a number of assets in that portfolio. Very likely more investment to come from a phase 2 approach at Valentine, but much smaller in terms of the quantum. So 2026 is it's expected to be a very pivotal year for us. If let's take an analyst expectation for next year is somewhere around 1 million ounces of gold. This year we're doing I think in total 785 to 915. But no guidance has been put into that from Valentine. And Valentine, we know, based on the study, is about 195 to 200,000 ounces a year in the phase 1 approach. So you add that in there, you're roughly 1 million ounces a year. And with adding in Valentine and with adding in Greenstone, they should lower the overall total cash cost and all-in sustaining costs for the business. So if we look at those expectations, I think right now analyst expectations are around $1,700 all-in sustaining cost and around 1 million ounces. So if we have anything like we have now, Jordan, in terms of the current gold price, let's just say 3,000. 3,000 through 2026 is going to give the business something close to $1.3 billion of operating cash flow. And fortunately, we have a lot of tax pools and net operating losses to carry forward because of the builds. So we should be in a very strong position to delever. And I believe in a position in a short period of time, let's call it 12 to 24 months, where I believe the business could be looking at a capital return to shareholders policy, just because the significant amount of cash flows that'll come and the deleveraging of the balance sheet. So an exciting time for the business.
Okay, Ryan, let's talk about, and this is something we talked about, I think a couple months ago. You outlined for me, okay, there's two or three things that the company needs to do. When we do these things, you will expect the stock can be re-rated. That valuation will move up significantly.
Yeah.
Um, can you go through those things?
Yeah, absolutely. So, I mean, we've kind of gone through the pain box now, right? We've now reset expectations insofar as we can now, as expected and anticipated, meet or beat those expectations. I think that's a really critical, fundamental part of this story moving forward. It allows us a foundation of which to rebuild credibility from. Part of the reason that I think the perception of Equinox is I don't know if the company is going to meet their expectations. I don't know if they're going to meet guidance because for the last few years that hasn't been the case. Now with that reset that happened in June, we can look to okay, there's a reasonable expectation we can move forward. In knowing that, I believe we're going to get through Q2 here. It's going to be a bit of a messy quarter with the adjustments from the transaction, and similar spend and similar production as Q1. July forward, I think things are going to really start to change. You're going to see, I believe we're going to see step changes in the output of from Greenstone. We are going to see positive developments and news coming out of Valentine, if according to the plan, we meet those expectations in terms of timelines, which right now we're confident that we will. So you're talking about the getting Greenstone to nameplate. I think that's going to build some confidence. Getting Valentine into production. Hey, it met those expectations and then started to produce. So like Q4 this year, I'm not sure exactly what it'll be, but let's assume that we ramping up and things are going well. We should be 20 to 30,000 ounces out of Valentine in Q4, right? So we have quite a bit of momentum happening at the moment with the way the business is tracking. So you get those two, even advanced from where they are today, that's going to be a step change in the right direction, right? Things in Nicaragua are going well. We're having a very strong first half of the year. Now I would anticipate 70 to 72,000 ounces in Q2. What did we do? 72,000 ounces in Q1. So those operations, mature operations, but we're meeting those expectations. And I believe that we should be set up for a pretty strong second half as well. So when you look at the company today, first half versus second half, you're tracking quite well to have a very strong second half of the year. Couple that with what the positive outlook will look like for a full year, getting these assets to nameplate, as we just talked about, 1 million plus ounces a year. But what I'm really excited about is what could be sprinkled on top of that. For example, that Equinox has talked about Los Filos in the past. So Los Filos is currently on care and maintenance. Right, we're working through all of the different details with the communities there to get some community agreements in place such that we can have good, strong, long-term social license to operate collaboratively together. I believe there's great potential there. If we could look at getting that done and then look at the strategy going forward around that, if you were to put a CIL plant in place there, which it is permitted for, and there is auxiliary permits that are required, you're looking at, based on the previous feasibility study, it's something like 275 to 300,000 ounces of gold a year. You also layer on a Castle Mountain. Castle Mountain is an exciting phase 2 development, an asset in California, a heap leach mine in California that's going through the permitting process there. We anticipate by the first half of 27, we should have a permit in place for that, which could lead to another tier 1 jurisdictional asset. Based on the I think it was a 2021 or 2022 feasibility study, that would be about 200,000 ounces a year of production growth. So you're getting these tier 1 quality jurisdictions, substantial long life assets, generating very robust operating and free cash flow, delevering the balance sheet. As I talked about, you've got great growth there, and we're trading at a fraction of what our peers are. And I look at peers being somebody that has that type of key metrics in the story, like an Alamos or an Agnico Eagle. we have the team, we have the assets to now deliver and build a top valuation global gold producer. So very excited about that. And then you layer on exploration on top of that. This company is going to be very focused on exploration upside because each one of these assets, and we've talked about Valentine, has tremendous exploration upside. I think this year we're spending between 70 and $90 million across the portfolio to see for resource expansion and discovery drilling across that asset base. So it's a long-winded answer, I know, but there's a lot in here to unpack. And there's a lot of potential. It's just now focus on operational excellence, delivering and meeting expectations, and building the business around that.
Okay, Ryan, you've covered so much. Is there anything that maybe we missed or just any final things you'd like to say or share?
We've covered a lot of ground. What I will say is when we look at a broader peer group, when we announced the deal, I believe the share price performance has been flat to down since we've announced this deal in February, whereas our peer group has, on average, gone up about 30 to 40%. So this is change, and sometimes change, people are resistant, investors are resistant, uncertainty around it. We need clarity. We need some more time to understand what this looks like, and that's fair. Equinox currently trades at about $5,700 per ounce of production, 2025, 2026. And the peer group average, I believe, is around $12,000 per ounce of production. The top quartile is trading around $15,000 per ounce of production. So you and I are doing this interview now, understanding what is to be unpacked and what the opportunities are in front of us. And you've rightly identified this as an opportunity because it hasn't traded like the peer group. And very likely you want to understand what does the future hold. And you've seen this track record of the company. So you're not the only one. People are starting to come to us that were originally resistant to understanding this and seeing what the opportunity is, now coming in and saying, the valuation here is just, it's far beyond where I thought it would get to versus this peer group. Everybody's had a run, you haven't. Help me understand what's going on. Help me understand what the future looks like. So yeah, I think it presents a very compelling opportunity at this point, barring your view of gold. If you believe that the price of gold is going down, I think it's going to be probably more headwinds for us. If you think long term, gold's probably going higher, it's flat to going higher in the long term, this is probably something you want to start looking at.
Okay, Ryan. Well, thank you so much for joining me today. I and my listeners really appreciate it. And let's do this again the coming months, and we can talk about how Greenstone is ramping up and Valentine is spitting out gold.
Look forward to it, Jordan. Thanks very much for having us on.